Good morning, Millionheads. Today is Thursday, February 16th, 2023. Opening bell go ding, and markets are down kind of big this morning. Looks like somebody was paying attention to that video I did last night about how the whole market seemed dead set on fighting the Fed. And that's rule number one of investing is don't do that. And well, the bulls didn't really like that video I put out last night. I'm sorry, bulls. I got to call it like I see it. And look, full disclosure, I wear it here on my sleeve in invisible ink. It says Perma Bear right there. I swear you can't see it, but it's written there. Anyways, we got a lot of data today. And well, long story short, we have got more inflation in January. Turns out January we saw a big wave of inflation came in, and we've got less manufacturing, less economic activity. And so I've got 10 minutes of your time or so, and today we are going to drink from the proverbial fire hose of economic truth and justice once again. Let's get into what's going on in markets this morning. We have got the S&P opened down about 50 points or 1.2% at about just under 4,100. The Dow is down 135. We were down almost 300 right before the open, currently down about 0.4%. And the NASDAQ is leading away lower, down 163 or 1.36%. Below 12,000 at 11,906. The DXY is on the rise this morning. U.S. dollar at 104.03, continuing that spike that we've had since the beginning of February. Dollar go up, stock go down. We've been seeing that for quite a while now. And over at the bond market, looks like we've got higher interest rates. This is the bond market telling us inflation is getting hotter, so the price of future dollars is going up. Right now, the 10-year Treasury is up about 4 basis points or 1% at 3.84, continuing that big run in the 10-year. Take a look at this one. Really, since the beginning of February, since just after Jerome Powell's speech at the FOMC, we have been running up. And if you want to know why did we see a surge in inflation at the beginning of the year, well, take a look at this dip in interest rates that we've had really since the beginning of November. Lower interest rates means more credit expansion, more money in circulation. So cheaper debt means more money. That's inflationary. And so we're seeing this second wave of inflation caused by this loosening of economic conditions, the lower of the 10-year yield. Well, that is just now starting to reverse. So we'll see if this second wave of inflation has any legs. Looking over at the commodity space right now, we have got gold is down about $3 this morning, or about 0.2% at 1842. Silver is down about a dime at 21.43, about 0.5%. And looking over crude oil, WTI is up about 30 cents this morning, about 0.4% at 78.89. And natural gas is up a nickel or 1.9% at 251. Still have not initiated a position in that gas trade. I know others have. I'm still holding out on that one. Looking over at the oil chart right now, looks like oil is still in this pattern that we've been watching for a little while. We broke back up into it. Interestingly enough, in oil markets, take a look at this yesterday. This is Energy Information Administration. That's government numbers. Stocks of crude oil in the U.S. surged by 16.3 million barrels last week. That is a huge inventory build. This trend of inventory builds is continuing, even though we stopped dumping the Strategic Petroleum Reserve. I know there was a story a few days ago about another 20 million barrels or so that were going to be released. Those were previously announced dumpings that we decided on that back in 2016. That happens every year. That's nothing new. The Biden administration, they pulled it forward a little bit, but it wasn't a new release. We shouldn't be seeing these massive builds in inventory unless economic activity is really slowing. And well, that's exactly what's happening, isn't it? Let's move on from this one. Big story this morning, the Producer Price Index, or PPI. This tends to be kind of front-running CPI. It's another measure of inflation. This is what the producers are paying. Well, this one came in at 0.7% month over month when the market was expecting 0.4%. That is another hotter than expected inflation reading. Core PPI came in at 6% versus the expected 5.4%. So this is indicative of potentially a higher CPI print even for February. PPI tends to front run CPI. Now here's an interesting trend I'm seeing developing. The year over year number was still down. It came in at 6%. That is hotter than expected. We were expecting 5.4, but still down from the 6.5 we saw last month. And that's because of the base effect. Keep in mind, it was a year ago that we really started to see these surges in the inflation readings. So the year over year numbers are going to start coming down because we're comparing to some big jumps from a year ago. Well, the month over month numbers are just starting to rise. So keep in mind, the media and the press, they may zero in on the headline numbers, which kind of paint a rosier picture because of the base effect from a year ago. But those month over month numbers, you have to watch those because the month over month number rising, that shows a new trend could be forming. So keep an eye on that one. Also going on today, we got the Philly Fed Manufacturing Index. And we've been talking a lot about these manufacturing indexes, about these purchasing managers indexes, because this shows the state of economic activity in the country. This shows what is going on. Are we making things? Well, not really. The Philly Fed Manufacturing Index plunged to minus 24.3 in February from in minus 8.9 in January. Keep in mind, the index is based on zero. Anything above zero means manufacturing is expanding. Anything below zero means we're contracting. This was the sixth consecutive month of manufacturing activity remaining below zero, and the worst month since May of 2020. And check this thing out here, folks. Looks like, 6 negatives in a row, but really it's 8 out of 9 of the last weeks. We have seen manufacturing activity. 8 out of the last 9 months. We have seen declines in manufacturing activity in the U.S. So that oil chart, that build in oil inventory, that starts to make sense when you factor in the fact that we're not making stuff and stuff needs oil. Plastic isn't just about everything. Plastic is in the packaging. It takes energy to power these factories, petrochemical manufacturing. All these things are down, and so we're using less oil. Even if people might still be driving and gasoline demand is still holding up, we're using less oil here because we're just not making things. Big decline in manufacturing for the Philly Fed. Elsewhere in the economy, we got housing starts came in today. Housing starts fell by 4.5% from a month earlier to a seasonally adjusted annual rate of 1.309 million. And looking at that chart right here, big drop in housing starts in January. Now, I wonder, are we going to see that continue? Because we did see a surge in copper prices and we saw a surge in lumber prices for the month of January. So I'm wondering, are we going to maybe see a bump up in housing starts next month because we had those lower interest rates? I showed you on the 10-year chart a little while ago, interest rates had come down. So I'm wondering, was there a little bit of a surge in building that started in February? Maybe it'll start showing up in some of these future numbers. Also looking here at building permits, which tends to front run housing starts. We got a little bit of a bump in building permits in January, up 0.1% from a month earlier, but that's compared to some pretty lousy numbers from the previous months. Keep in mind, look at that November number, down 10.6%. So there's two ways you could look at these real estate numbers, right? You could say the builders are slowing down, and that's a sign that the housing market is weak. The builders don't want to build these homes and be stuck with them. Another way you could look at this is saying the builders are being cautious, and so there's less houses starting to be built. That means less supply hitting the market a few months from now. Well, if you look at it that way, that could be bullish for housing prices. It's important to look at both sides of the trade and make up your own mind here. I'm not going to draw too many conclusions from these real estate numbers just this morning. I'm more interested in the jobless numbers. And funny, I should mention that because here we are. Initial jobless claims in the U.S. declined to 194,000 in the week ending February 11th, down from the previous week's 195. So initial jobless claims are still very low. All these stories of layoffs, they have not yet hit the jobless claims market. That's important. These people are getting severance and they're getting benefits, or it takes a couple of weeks for them to apply for unemployment before they get the initial claims. Whatever it is, these big stories of these layoffs in big tech, it's not yet showing up in the initial jobless claims. So the jobs market right now, on the surface, it still looks to be a little bit tight, even though I've been a pretty big critic of the government job statistics as of late. Also, it's something to keep an eye on. Looking over at continuing jobless claims, they're continuing to rise a little bit, even though we're getting the slow initial jobless claims. When you see continuing claims, this is people who have been on the jobless claims, the unemployment benefits, for a couple of weeks in a row. And this is important because this shows that once people file for unemployment, a lot of them are staying on unemployment. They're not finding jobs right away. So initial claims rose to 1.69 million. They're up a little bit, but take a look at the 1-year chart and you can kind of see that it's starting to rise. We do have this steady uptrend in continuing jobless claims. Not alarming numbers yet. We're still below 1.7 million, but it does show the trend in the labor market has been reversing for some time, yet it's still not a big issue. Also, going on in the news today, check out Bitcoin up big, currently trading around 24,300. It was pushing 25,000 a little while earlier. What's going on? Is crypto going to surge again? Are we on and up to 100,000? I don't think so. I think what's going on, and shout out to Kieran Von Hest, a.k.a. Deso Games on Twitter. He tweeted this chart out today. This is the market cap of Binance USD or BUSD. That's the Binance stablecoin that's issued by Paxos. And there was a story earlier this week where the financial regulators in New York basically ordered Paxos to stop issuing any of these BUSD tokens, that they were breaking whatever law or whatever interpretation of the law. And ever since then, there's been a surge of redemptions of these BUSD coins. And you can see here, this is the market cap of BUSD dropping by over $1 billion in just the last day. So what I think we're seeing with this surge in Bitcoin prices, I think that's people dumping their BUSD and fleeing into Bitcoin because it's easier to buy Bitcoin with your BUSD than it is to convert it to cash and get it off the exchange. That is just my unrefined opinion on what we're seeing in crypto right now. Again, some of these guys who are better with the Chainalysis, maybe some of them could paint a better picture of what's actually going on in crypto. All right, I want to send a shout out to my good friend, Mr. EC660. Where are you, EC? I know you're in here somewhere. He says, please tell me my loving government has a plan to save me. I'm broke, no gold, no silver, no beans, no frickin' rice. Well, EC660, first of all, yes, we are live right now. And let me just tell you this. If you have no reserves, you got no gold, no silver, if you have no food stores, no beans, no rice, that doesn't mean you're hosed. You still have your time, you still have your energy, and that you control how you use that. And you're already here at YouTube University learning something. So all I can tell you is, even if you've got no cash, no money, no beans, no rice, no food, no nothing, you can still go there, go online. You can learn from an expert how to fix something, how to build something, make something, grow something. All that information is out there. You are better equipped to deal with what's coming than any person at any point in history prior, because you have ready, easy access to the combined knowledge of mankind. Nobody through history has had what you have access to. So no excuses, EC660. You can do this. And hey, if you're watching this channel, you're already on your way. And thank you, sir, for the super chat and the support of the channel. You are a gentleman and a scholar. And I know somebody else was in here. My man, Steve Woitis, is here. Thank you, Steve, for the super chat and the support of the channel. He says, thanks, NSF. Please keep us informed. That is what we're trying to do here, brother. We try hard. We do this every day at 9:30. Also want to send it. Thank you, Steve, again for the super chat. Want to send a shout out to my Patreon supporters. You guys are awesome. Had a good time talking to you yesterday on our Zoom call. Link down in the description should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Everybody have an awesome day. Until next time, live small and dream big.